Hi, Else here, and today we're going to talk about non-monetary exchanges. However, in order to do that, we first have to understand what a monetary exchange is. The easiest way to do that is to compare the terms monetary and non-monetary with regards to assets. A monetary asset is either money, you can see the connection between monetary and money, or a claim to money at some point in the future. Claims to money are assets where the amount and timing of the collection is determinable. The most common monetary assets that you might give up would be, of course, money, but also accounts receivable and notes receivable. Both of these are monetary assets because the future cash receipts are known, both in amount and timing. So what are non-monetary assets? They are everything that is not a monetary asset. Maybe not a very helpful definition, but that's what it is. What does it mean? It means any asset which does not have a fixed or determinable future cash flow. Again, not very helpful. Maybe a few examples would help. Inventory, for instance, does have a future cash inflow, but you don't know exactly how much or when the inflow will happen, since you can't say exactly when or how much you will sell your inventory for. Property, plant, and equipment is another example. You know it will be used to create future benefit in the form of revenues, but you can't quantify the amount or timing of that inflow today. Finally, you may purchase the shares of another company as an investment, which you hope will result in a future cash inflow, but you can't right now determine either the amount or when it will happen. Now that you understand the difference between monetary and non-monetary assets, we can move forward with a question. What is a monetary exchange in regards to capital assets? Capital assets are also called property, plant, equipment, and intangibles. A monetary exchange is when you get a non-monetary asset, such as a forklift truck, in exchange for giving up cash. Note how this meets the definition of a monetary asset, because we know the amount and timing of the cash outflow. We already gave away the money, so of course we know the amount and timing. What if we give up an accounts receivable instead? Is it still a monetary exchange? Absolutely, because the amount, which is how much the accounts receivable is for, and the timing, when it is due, is known. Wait a minute. Do you see something strange here? When we get a forklift truck and we make a promise to pay cash in the future, don't we record an accounts payable, not an accounts receivable? That's very true. Our entry in our accounting records would be a debit to equipment and a credit to accounts payable, because we owe cash at some point and time in the future, which is known. However, what did we give up to the other entity? We gave them an accounts receivable, a legal right to collect cash from us at some date in the future. That's why we talk about giving up an accounts receivable, because that is what we give to the entity we purchased the forklift truck from. The same would be true if we gave up a notes receivable. We give the other entity a notes receivable, a monetary asset, and we record a note payable, which is a monetary liability. What if we were the entity that sold the forklift truck? Is this a monetary exchange? Yes, it is, because we give up the truck. What would we get in exchange? We would get a monetary asset, either cash, amount and timing of inflow is known, or an accounts receivable or note receivable, both of which are monetary assets since we know the amount and timing of the future cash inflow. If we're the entity making the sale, we give up a capital asset and we get a monetary asset in exchange. Standing again in the position of the entity that gave up the capital asset, what happens if the value of what we gave up is greater than the value of what we receive? How is that recorded? We would record a loss on disposal, a debit to the statement of comprehensive income, which would reduce income before income taxes. This loss is recognized in income because it is realized. We actually converted the asset truck to either cash or a claim to cash in the future. What would happen if the value of what we gave up was less than the value of what we received? In that case, we would record a gain on disposal, a credit to the statement of comprehensive income, which would increase income before income taxes. Again, the gain is recognized in income because it is realized. We again converted the asset truck into cash or a claim to cash in the future. Okay, now that we understand monetary exchanges, what would happen if we exchanged our forklift truck for someone else's forklift truck? Or we exchange our forklift truck for a scanner/copier/printer for our office. In this case, what we have done is disposed of the old capital asset at the same time as we purchased a capital asset. We have both a sale and a purchase of a capital asset rolled into one transaction. This is known as a non-monetary exchange, and when it occurs, there are a few questions which have to be answered. 1. How should we determine the value of the asset received? And 2. Should we record a gain or loss on the sale of the asset we gave up? In our next video, we'll answer these two questions so that you know how to record a non-monetary exchange under IFRS.